Open your renewal notice. Look at that number. Now look again, because you know you have the exact same house, same roof, no claims, no water damage, and yet your bill jumped. Maybe $200, maybe $500, maybe a lot more. The immediate assumption is usually inflation. Lumber, copper, aluminum, and the skilled labor needed to assemble them all got considerably more expensive over the last few years. Insurers call this replacement cost, the actual price tag to rebuild your house from scratch if disaster strikes. That specific metric has climbed much faster than the broader inflation rate you see at the grocery store. But local construction costs only explain a fraction of the hike. They fall completely short of explaining the true financial shock hitting your wallet. Look closely at the geography. Homeowners in Nebraska and Georgia are seeing their premiums jump over 20% in a single year. These are states largely isolated from the hurricane coast and far from the massive western wildfires. If you live in a quiet, temperate grid like this, far from fault lines or hurricanes, you shouldn't feel this financial squeeze. If this were strictly about local building materials getting pricier, the rate increases would be relatively even across the entire country. The data shows they aren't. A massive, invisible variable is driving this national surge, and it is entirely unrelated to your local environment or the physical structure of your house. Your local insurance company is actually a customer itself. Because they take on enormous amounts of risk across thousands of homes, they have to buy their own macro insurance policies to ensure they don't go bankrupt after a single bad storm. It's an industry called reinsurance. These macro policies are traded and underwritten by massive global firms operating out of financial hubs like London, Zurich, Munich, and here in Bermuda. This chart tracks the cost of that global protection. Between 2018 and 2023, you can see a violent 100% upward spike. Researchers call this a reinsurance shock. The global firms realized they had severely underpriced the risk of extreme climate events for years, and they corrected the math all at once. When your local insurer gets hit with that massive new expense, they do exactly what you'd expect. They take that global penalty and spread it out evenly across every single policyholder in their regional portfolio. A homeowner in an Omaha suburb is quietly subsidizing the financial fallout of catastrophic events happening in Miami. That is how the math works today. Insurers used to model major disasters as once-a-decade events, giving their financial reserves years to recover between massive payouts. Now, those events compress into shorter timelines, showing up 2 or 3 times a decade and eliminating the cushion. At the same time, we've seen a massive demographic shift. Over the last 20 years, Americans built larger, more expensive homes directly on flood-prone coastlines and highly vulnerable hillsides. The size of the potential payouts grew exponentially, alongside the frequency of the disasters. Look at California's recent history. The compounding losses from sprawling valley smoke and multi-million-dollar property damage forced insurers to completely abandon their old pricing models, with several carriers pulling out of the state entirely. Every localized loss in those coastal or wildfire zones flows immediately backward into that global reinsurance pool. Regional climate catastrophes do not stay regional. The costs are instantly globalized. Living far away from the disaster zone no longer protects your household budget. This financial shock often stays hidden. If you have a mortgage, your insurance premium is likely bundled directly into your monthly payment through an escrow account. When homeowners get a letter showing their fixed-rate mortgage payment jumping, they panic. The interest rate hasn't changed, the loan balance hasn't changed, but the total monthly obligation explodes upward because the insurance portion inside it doubled. Look at this comparison chart. From 2021 to 2025, the growth rate of insurance costs radically outpaced both wage growth and standard rent inflation. You cannot negotiate with a global climate model thousands of miles away. That makes this hidden line item the fastest growing financial threat to everyday homeownership. You can't control the global reinsurance market, but you do have leverage. First, aggressively shop your policy every single year. Rates vary wildly between carriers for the exact same house. Exploiting those pricing gaps is one of the highest return hours you can spend on your finances. Second, look at your deductible. Raising it shifts the micro risks back onto you. By taking on the small stuff yourself, you directly and meaningfully reduce the macro premium the insurer charges you. Third, look into physical property upgrades. Adding an impact-resistant roof, installing storm shutters, or updating your electrical panel are some of the few ways to actively manipulate how the algorithm scores your specific home. Finally, demand the exact classification of your rate hike. Find out if it's a non-negotiable global pass-through or a localized property assessment you might actually be able to appeal. The math changed. Understanding how the global risk pool works means you can stop staring at that renewal notice in frustration and start exploiting the few points of leverage you have left.